Good afternoon. I welcome you to today's webinar here with Admiral Markets, the weekly market outlook, as usual, every Friday at 12 p.m. London. Yeah, my name is Jens Klatt, and I'll be the moderator, the host for the upcoming 45 minutes. I have to say, I'm really happy to be here today. Today is in fact, to some extent, a special day because we had so many great events over the last days, and there are so many important and exciting events then over the next days, with probably finding a climax with the G20 summit in Osaka next weekend. So from the 28th, 29th, if I'm not mistaken. Why this is of interest for the markets. And beside of that, also now the hopefully not escalating, but still very tense situation between the US and Iran here, which nearly saw a war breaking out yesterday. Is something which is of high interest for the markets. We have today the big expiration in the DAX, which means triple witching, so options and futures, which are which now expired. In fact, have seen some volatility based on that. Let's see what this will bring us for the upcoming minutes. Then there was some volatile price action already. We had already on Tuesday. We had Mario Draghi in Sintra, Portugal. We had the Fed on Wednesday. So there are plenty of potential drivers. Not for high volatility only over the last days, but potential triggers and drivers for the days to come then. And I have to say, I'm really excited and I'm really happy to be here today. So before we start, nevertheless, let's have a look here at the risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. These were only the first 2-3 sentences from the risk disclaimer. The full risk disclaimer can be found on admiralmarkets.com on the website. And we, as usual, want to nevertheless dig a little deeper into a decision from the so-called ESMA, which is now differentiating, or the ESMA decision targets retail clients especially, and is now differentiating here between retail clients and professional clients in regards to the balance protection, in regards to negative balance protection, but also the leverage. First of all, let's have a look here at the leverage. So there's now a leverage restriction for retail clients with a max of 1:30 for Forex majors like EURUSD, for example, dollar JPY. And 1:20 for other currency pairs, so-called minors, GBP, Australian dollar, for example, just to name one. Also 1:20 on CFDs on indices like the DAX 30 and also gold, for example. And now where's the differentiation between professional and retail clients, respectively retail clients with this leverage cap and then professionals. So professional clients, if they meet certain criteria, they are not affected by this leverage restriction here. They can still trade with a leverage up to 1:500 in this case, even though in the let's call it standard version, this if you're classified as a professional client does not necessarily mean that you have such a negative balance protection. And this is what is special about Admiral Markets here. According to the policy from Admiral Markets, you have negative balance protection up to £50,000, in fact. So in this context here, for further information, if you meet those criteria, if you really plan to apply, what does this mean and all this, feel free to reach out to the website from Admiral Markets to get further information. Contact Admiral Markets directly, the customer support in your respective language to get further details here. This is it around the ESMA decision then. So this is me, the face to the voice, and you're currently listening to. What I want to mention here only is that I'm located in Berlin, Germany. Admiral Markets has an office here, by the way, just for information. They have plenty of offices around the globe, in fact, but especially here in Germany, we usually refer to Admiral Markets as the so-called DAX expert. And the question obviously is why. In fact, they have a typical spread here of 0.8 during the main trading hours, which is already very competitive. And then there's now the offering Admiral Prime, where you have a typical spread of 0.2 on top, or in addition to that, you then pay a commission. This is very interesting for those traders who are very short-term oriented and are scalping the markets. On top of that, there's also a very competitive offering in regards to FX trading. So this alone makes it definitely worth to give Admiral Markets a deeper look here. Also, feel free to reach out to the website in your respective language, and if there are any questions, feel free to contact Admiral directly. Here, One World Global Offers. So Germany, I already mentioned it with the office in Berlin, but there's also an office in London, for example. There's one in Chile, for example. There's also one in Australia. So around the globe, you can find Admiral Markets. It's an Estonian company then. So there's plenty of opportunities and regulations and authorizations. Also further information on the website. And there are the contact details, and then we want to dig into the agenda from today. We want to answer the following questions. What are the key economic events in the coming week of trading? I already mentioned a few at the beginning. And then, sure, we want to answer the question, what's the current bias in FX, equity, and commodity markets? So what we clearly have seen is the US dollar being crashed. I think several of you have closely watched the price action. And on the other hand, we finally saw the break higher in gold, for example, above this multi-year resistance zone, 1,360, 365. Shall we buy this break directly, or shall we probably wait for a pullback to happen? I'd probably go for the second one after seeing today's price action, after we saw a short stint, a squeeze above 1,400 USD per ounce. And sure, then we have already here the third question on the agenda for today, which trading opportunities may arise. And then we switch over here to the MetaTrader in this case and have a look. So unfortunately, I just found out shortly before I started the webinar, I found out that I haven't prepared the hourly chart here in the DAX. I'm not even sure if it's really necessary to prepare it right now, since we want to give an outlook for the upcoming week of trading, but probably it's of interest to get an idea of where do we stand right now and why the price action, especially of the last minutes here, was very interesting. Just let me have a look here. So the high was 379. Oh, okay, interesting. Okay. So it's very interesting. Let me just take this out. That's probably something we need here. So we have a sequence of higher highs and higher lows, and there was a potential fake out at the beginning of the week. Probably have seen this. That was around 12,050 points. That was on Tuesday, and it gives us a perfect idea, not idea, but possibility here to then stay right into what happened over the last days, and what to make out of all these developments. First of all, around the FED and the ECB decision here. So first of all, there was a quite, let's say, unspectacular start into the week of trading. On Monday, we haven't seen much of action here. That was here on the 17th. We've seen some choppy price action, some sideways action here, and all in all, it seemed as if till Wednesday there's no big action to be expected with this very important and very interesting rate decision here. And the question which had to be answered, will there be already a rate cut on Wednesday or not? So there was a chance, especially after the latest economic data we have seen, but also based on the comments from Jay Powell, the Fed chairman, for example, who opened the door for a rate cut. And when looking at the Fed Watch tool, for example, we'll look at this in a few seconds, or a few minutes, let's say, then we surely have to say that there was definitely a chance of a rate cut already on Wednesday. And if there's no rate cut, that was something which we know right now. There was no rate cut, so the Fed kept interest rates at this level between 225 to 250 basis points. Then at least it was very likely that there would be a very, very dovish rhetoric. And so that was already something we could have expected, but still there was some uncertainty of if it really plays out that way or not. And now the interesting thing was that well, it wasn't interesting, but it could be expected here that we start very, very unspectacular then into the week. And then on, let me just have a look here. And then the interesting thing was that on Tuesday, we initially started with a drop lower here. So that was when we pushed below 12,050 points. And it really seemed as if probably we'll at least see a short stint as low as 11,900 points around. That it really seemed very, very bearish day. And we started out quite weak. And I have to say, from a sentiment perspective, didn't come as such a big surprise, because all in all, it really seemed as if it was too clear that we are very unspectacular and unexcited drifting into the Fed event, and especially with the short-term importance, as I would call it here, around 12,050 points. Somehow you had the feeling that probably a push lower seems likely then, because everyone was expecting to some kind of dovish Fed and some kind of spike higher. So that and afterwards, I have to say it didn't come as such a big surprise. But what definitely came as a surprise was that when I headed to breakfast, or no, I only had a coffee. I came back and I just saw this huge push higher in the DAX. I was just looking and just thinking, okay, what just happened? So there must be some big news now. I'm hitting the wire, most likely in regards to the Fed. And I was mistaken. It was nothing around the Fed, but it was instead, and I prepared it here, it was Mario Draghi, who came out in a very, very, very dovish way. Let me just give you here an idea of what happened. So this is a chart from Bloomberg showing now after the speech from Draghi in Sintra in Portugal, which only aimed to it was to some kind a birthday party of the euro, respectively of the ECB, 20 years, and so all in all, it really wasn't something spectacular. It was just like expected. There will be all important central bankers around the ECB. There's some of them will probably give a little speech and everything's fine. But Mario Draghi came out very, very dovish, and opening the door for further rate cuts, in fact. And the result was that on Monday, we had an implied probability of an ECB rate cut by September of only 40%. So it was already elevated, but still was not that the market really expected the ECB to cut rates. And then the words from Draghi pushed this probability significantly higher, up to 87%. As a result, the euro dropped below 112, by the way. And on the other hand, as expected, as one could expect here, was that the equity markets, especially the DAX, pushed higher. Didn't take very long. In fact, let me just probably go the other way around. Probably we probably should take another route here, a different route. So the question which came to my mind immediately after I saw this was, why today? Because I mean, it was only an anniversary. It was some kind of a birthday party. It was nothing spectacular, to be honest. And especially, it was very short before the Fed rate decision. So why does someone has an interest, especially the ECB president, to that aggressively down talk the euro before such a crucial central bank meeting as the Fed was on last Wednesday? So at first glance, it didn't make sense, and then the second, when you thought about it several minutes, it perfectly made sense, because you can expect central banks to communicate with each other. If they are not directly communicate with each other, there are sources which give you some information in some way what to expect about this central bank meeting. And this aggressive attempt to down talk the euro could clearly be interpreted as Mario Draghi knew that the Fed will very likely come out very, very dovish the next day. And when looking at the current developments, especially, for example, the latest data, economic data from Germany, you can clearly see a recession forming at the horizon. It's not only the inversion of the yield curve in the US, which points to a recession, but it's also several signs pointing to a potential recession forming at the horizon in the Eurozone / especially the biggest economy of the Eurozone in Germany. So with this in mind, you definitely are interested in somehow try to down talk the euro and to somehow counter any potential negative impacts, such a yeah, I mean not such a recession, but a too high valued euro would have on your economy, and you somehow try to dampen this outlook in regards to the recession. Then you try to anticipate it by down talking it, and let's see what happened. I have prepared it here. It's a tweet from Mr. Donald Trump. No big surprise. Mario Draghi just announced more stimulus could come, which immediately dropped the euro against the dollar, making it unfairly easier for them to compete against the USA. They have been getting away with this for years, along with China and others. So obviously, Donald Trump saw what's happening here, even though I'm not really sure if he's the right one to complain here when looking at his aggressive attempt to take to make an impact, to influence the policy of the Fed over the last months, respectively over the nearly last 9 months, especially when looking at the high volatility in markets over the fourth quarter in 2018, for example. But still, it becomes obvious that that this is quite clear. And this tweet, by the way, came after I thought about it already. So it's not that it that my idea was here impacted by this tweet from Trump, but it also shows something different, which is by the way, then something you should be aware of when we look at the developments in Euro USD, especially in a few minutes. This tweet shows that there is also some tensions between the US and Europe expected, or should be expected, in regards to trade. So he's also mentioning China. When we know that there is this G20 summit next weekend in Osaka in Japan, and there's some hopes that there will be some signs of a deal to some extent, even though we have to say it's very unlikely. And the same is true when looking here at this tweet. The same is true for the euro, which means there is a high chance that rather sooner than later there will be also tariffs, or at least a very, very aggressive rhetoric in regards to potential tariffs on especially the automobile sector, European automobile sector, from Donald Trump, which means, on the other hand, that here every bullish attempt on the upside, and so far we haven't yet spoken about it, but we will see that the outlook for the US dollar is very, very bearish, in fact, after this Fed rate decision, even though we should be really careful and aggressively going Euro USD long here. So probably it makes more sense if you really plan to short on the US dollar, based on all the ideas I will formulate in a few seconds, that you probably look for currencies like dollar JPY, for example, also because of the yield sensitivity of the JPY, but also that you probably look for gold long positions. Usually it's there's a negative correlation between the USD and gold here. Euro is probably not the right place to be with expecting aggressive attempts in regards to tariffs and all this on the European automobile sector, especially from Trump and the Trump administration. And this can clearly be seen here in this in this tweet, in my opinion. So okay, what? Oh no, that's probably a little too much then. That is that's after what just happened. Probably we start here. Let's start here with a dot plot. And by the way, let me just Let me just enlarge this. That makes probably more sense. So what does it show? It's the so-called Fed dot plot. So every dot here in this chart is one FOMC member, and it shows where the FOMC members, or every FOMC member, is seeing the yield over a certain time span here, within which period. That means when looking at the May dots, for example, you had here the majority of Fed members, which is in fact 18, if I'm not mistaken. Let me just see, 5, 10, 11, 17. So if I'm not mistaken, it should be 17. If it's not 17, it's 18. Doesn't matter. But what's important is that the majority obviously saw the Fed to keep rates steady here between 225 to 250 basis points. So this is here on the right axis. You can there see there's usually a band. Okay, so the difference here, and you can see here that this is the current rate level, and there were only hikes be seen at the May. That was 6 weeks ago at the May meeting here, and this shifted, and it shifted in an interesting way. It's very dovish, yes, but still it shifted only to a small majority seeing no change at all over the next months in 2019. And why is this noteworthy? It's noteworthy because it completely contradicts what we get to see in the markets and in the Fed watch tool so far. So, which means nothing more than the market here, and this is what we can see here in the so-called Fed watch tool. There you see it, 225, 250. This is the current target rate, and with a 100% likelihood, it's 73.9% seeing at least a rate cut by 25 basis points, 26.1 see a cut by 50 basis points. I think this, to some extent, depends a little on what will happen at the G20 summit next weekend. And that was also something we could see in the Fed statement and in the wording from, or rhetoric from Powell at the FOMC rate decision, or at the Fed rate decision here on Wednesday. There was a mentioning of the G20 summit, and if there's any sign of a clash, let's say, between the US and China, and harsh rhetoric happening, this is not only capable of pushing equity markets lower, but it's also capable of really letting this column here increase dramatically, and increase chances that the Fed will be very, very, very dovish then at the July meeting, at the end of July here. But nevertheless, let's come back to the to this divergence between what the market expects and what the Fed is showing here. So this is very, very interesting to see that the Fed, or the FOMC members here, that they are not as dovish as the market is right now. And the question is, to some extent, why? Probably the main reason is they want to have some room to act, let's say, just in case that there is a real clear not only escalation in regards to trade, but there's also other ways of escalation in regards to the economic outlook, which worsens dramatically, let's say, a recession coming sooner rather than later, and all this is probably the main reason why the FOMC has not yet included such a dovishness as the market is already pricing in here. So this is only the July meeting. Let's have a look here at December. You can clearly see that when clicking here at the December tab, you can clearly spot that there the market is obviously seeing with 2/3, so it's nearly 66% is seeing 3 rate cuts and more than that. So 40% see 3 rate cuts. So this is the current target rate. You see 100% that there will be a rate cut, and then there's only one rate cut seen by 5.8. It's already here 29.1 plus all these market participants. So in fact, 84% of market participants are seeing minimum 2 cuts. And then you can see those 3 columns here. If you add them if you sum them up, you're coming out at 65, 66%, seeing 3 rate cuts, or even more than that. So there's already here, there's nearly 25% seeing 4 rate cuts till December. And this is very dovish compared to what the Fed dot plot suggests here, or is telling us. So with all this in mind, let's now switch over to the market. So there has been some information, but I think it's very, very important to have all this information available when looking here at the developments, especially in Euro USD. So what you can clearly spot here is that we are now currently trading still within a range, but that we are probably about to break out of this range above 1330, 1350 on the upside, and then going for a test of 114.50, 115 in the days to come. And this is mainly due to the fact that the US dollar, and that could clearly be seen afterwards. And by the way, let me just probably choose another chart here. Let me just close these two. So this is here. Draghi dumps the euro, and that Fed pushes the euro. So Fed pushes the euro, respectively, dumps US dollar, obviously. So they really pushed the US dollar lower, aggressively lower. And I think this is also something which should be expected then in the days to come. So there's several reasons to be really skeptical. So the market has probably aggressively pushed, no, I'm sorry, not pushed, but priced in a stronger US dollar. Therefore, even though this is not the current chart, will be updated today. It's now we want to have a look here at the commitment of traders report and the positioning of market participants or big speculators in this context. Fortunately, it takes too long. So, commitment of traders report, and then we'll look at the US dollar. You will see that the market is still, or big speculators especially, are still quite aggressively positioned US dollar long. It will be very interesting. Oh, in fact, no, not today. Next week will be very interesting because this data we get to see here is, or we'll get to see today, is from Tuesday. So it was one day before the Fed, and they did not have any information on that before. So we have to wait till next week to get a better idea of that. But you can clearly spot here there is still an elevated long position which stabilized at an elevated level, and it's likely that this will be reduced here. And on the other hand, we want to skip this now, but that we also get to see market participants start to buy T-notes, so big speculators especially, because yields should be expected to drop, especially 10-year yields should be expected to drop significantly below 2% in the days to come. And the yield advantage US dollar had so far is now diminishing more and more and more and more and more. And the more it diminishes, the higher the chance that the US dollar will keep on weakening. So it's not necessarily US dollar, euro strength here, which we get to see, but it's more a US dollar weakness, in fact, which is the main driver then for the strength. Still, remember what I just said in regards to the outlook for the Eurozone and the automobile sector. Anytime there could be tariffs being imposed by Trump and the automobile sector because he thinks it's necessary for whatever reason. I don't know. I mean, yesterday he was also tweeting something around Iran here, and that the Iran made a very big mistake. So we are talking about a very tense situation, a potential war, which could break out there anytime. And probably one of the mightiest persons in the world, the U.S. president, is tweeting about it in a very straight way, and in a way you usually wouldn't expect a president probably to tweet or to in general talk about such a topic, such a important topic. So with this in mind, we should all the time be aware of a chance that there will probably any tweet in regards to impose tariffs here on European goods, on especially automobiles from Germany coming, and this could definitely weaken the euro then. still, if this is not happening, then we should definitely favor the long side, and I'm seeing a potential break higher above 1330, 1350 with a push up to 1450, 115 in the days to come. So far it seems as if the long side should be favored. The advantage should be fine on the long side, but only as long as there's nothing which attacks the European export sector. So yeah, that's it around the Euro USD. Let's probably switch over to gold then and have a look here at this push higher. Very interesting price action so far. As you can see here, we've pushed as high as 1,410 USD overnight already. And let me probably switch over here to the traders block section on admiralmarkets.com. You can find it admiralmarkets.com and then go to analytics, and there click on the traders block there, and then you sorry, no, this is not the traders block. Today it's a technical analysis. Traders block is usually technical pieces in regards to patterns or seasonal patterns on all this, but it's a technical analysis here. So gold breaks through a multi-year resistance zone, strong buy. You probably remember not only the weekly pieces in written form, but also the several webinars we had in the past when it came here to gold and a potential very strong zone of resistance on the upside, 1,360, 365. And we finally made it through this level, and it was also it's not only a technical breakout, but it's also a fundamental driven breakout. So gold is usually positive, usually reacting positively on any drop in yields, aggressive drop in yields, any kind of risk off move, respectively any weakness in the US dollar. And this is all coming together right now. So it's not only that yields are dropping due to recession fears and due to a Fed to be expected very dovish in the next months to come here, but also in regards to the very tense situation when it comes to Iran in this case. So in combination, from a fundamental perspective, there are several bullish drivers, and this goes hand in hand then with a technical breakout, which is, by the way, leveling the path up to, in my opinion, 1,700 USD. Why do I say that? Therefore, let's have a look at probably weekly chart, because it's such a big formation, in fact. And we made this already a topic last week. Some of you probably recall this. So there you can see it. We have here a triangle forming. Just probably use this one. So you see a formation here with higher highs. It's not very clear because there was this short push lower that was here in the mid 2018 range, but still the formation can be seen, I think. And it's not only that, but you can also see that this drop lower here did not penetrate and drop below these lows here from 2016 in December. So this is holding the idea behind this pattern in play. What is the idea? It's a simple one. So you're seeing here market pushing higher, finding resistance around 1,360, and obviously when the market drops, the supply coming here into the market is pushing the market lower. And next time you attack this level, which happened, that was in 2016. By the way, we could also extend this to some extent and go here to this region, 2014 already. But let's look here at 2016. So the drop lower, that's in 2016. Then we get to see another attack, finding resistance again in the same region. We drop, but we do not find enough supply which is capable of pushing us below the lows we have seen here. So then the market is pushing to these levels again, and the supply coming into the market here in this region, so we are not only talking about 1,366 USD, but it's a region, okay? It's a resistance zone we are looking at here. So it does need to be it doesn't need to hit a certain point here, but to hit the region, the area here. And then you get to see the pullback, which is, again, obviously not finding enough supply anymore, but in fact, we are already here moving higher shortly after. And this push now higher is now penetrating this region, and we are breaking through it, and it looks really like the real deal, because the supply which came here into the market, respectively here, was just absorbed, and the market just could break through this level from a technical perspective. So this is the idea behind this rising graduate. I think we probably should call it an ascending triangle here. And so this breakout then looks really strong. And now the thing is, the question which arises is obviously, if this is really the real deal, so what is then a projected target on the upside? And therefore, you do the following. You look here at this formation, and you use the lowest part of this formation, which can be found here, and then you go to the high of this formation, and then you just duplicate it, and you get out here. You just duplicate it that way, and then you see that the projected target can be found in the region around 1,670, 1,700 USD. So obviously, that this is obviously now very strong and a very clear bullish breakout. Even though the question which comes to our mind is probably, do we or should we really buy this break higher here? Or probably shouldn't we wait for a pullback to happen? And this is definitely something I'd go for here in this formation. So I do not want to buy gold here. I'd like to get to see a pullback to 1,360 to 1,365 USD and try to buy gold here. The only problem with this approach is, do we really get to see such a pullback? Because it's again a very yield sensitive asset, gold, which means it's, based on my experience, very stable in regards to trends which are formed, which means if the trend is now continuing here, the best what we probably get to see is a stabilization at this current level, and then just some kind of a flag showing, and then there will be a breakout on the upside, and we'll continue with this strong momentum we currently see. Even though I have to say, from a sentiment perspective, in my opinion, there's too many people right now talking about this. So that became, by the way, clear in the morning when I brought my little kid to the kindergarten. I was talking to someone who usually has no connection to financial markets, and we were starting to talk about gold and the situation and the tense situation, also with President Trump and what could develop here, especially in regards to Iran and all this. And this is usually a sign, if too many people are talking about the same topic, especially about such a big breakout happening here, it's probably right now at least too late, and we probably should wait until this overheated market conditions have cooled down a little, and then go for a long position against this region around 1,360 to 365 in the days to come, and probably try to catch then the next wave up. Yeah, so that's it in regards to gold. And finally, sure, we have to have a look then also here at the DAX and the current situation. So yesterday and today, again, there has been some trouble right now here to break above 12,450 to make new yearly highs. This definitely comes as a surprise. I really expected a break higher. If not yesterday, was already likely, in my opinion. If it didn't happen, we were capable of holding above 12,300. That was the short-term line here of support, in my opinion. And I said, well, if we do not break below that, it's very likely that we are getting to see yearly highs today. And so then there was this push higher above 12,400 points, and it looked really as if we're now about to break higher. But this did not happen again, and in fact we now saw a quite sharp push lower, and probably the price action was driven mainly by this triple witching, which is now through. But again, it definitely needs some strong buying then in the US, and I'm not really confident if this is really about to happen. On the other hand, I have to say, I mean, well, we are here now breaking to new all-time high. So yesterday there was a short push higher, and the market didn't make a real strong follow through. Reason for that was the developments around Iran. Okay, but, and this is the thing, as you can already see here, there's now an interesting seasonal pattern forming, which is showing that over the last 21 years, if I'm not mistaken. I have to look up the numbers correctly. I only highlighted this to give you an idea of what I'm currently looking at. So what you can see here is that over more than 20 years in the past, within this time period, from, in this case, the 19th of June, that was the day of the Fed, till the 25th of June. So this is next week then, on Wednesday, I think so, yes. No, I'm sorry, Tuesday, sorry. So that within this small period here, this 1 week, usually you get to see by 81%, you have a higher chance that the market will drop in the S&P, which is probably one reason to be a little skeptical, even though I do not want to short first of all, the S&P into pushing to new all-time highs. Usually this is not a very profitable approach, if I'm not mistaken. I have no real clear numbers I can show you right now, but I know from experience that shorting new highs is sometimes a costly experience. And then there's also this seasonal pattern, respectively the no, not the seasonal pattern, but the stimulus from a fundamental perspective. Very dovish ECB, very dovish Fed. This is usually not an environment in which you want to short the market in, or in which you don't want to fade momentum, especially bullish momentum. Even though, on the other hand, we have to say that the reason for this dovishness and the Fed and an ECB statement, or the rhetoric they used here over the last days, is certainly skepticism around the overall economic outlook, long-term growth outlook for especially companies in the US, skepticism around the employment situation and all this. So it's usually something to be aware of, and which is not usually a positive sign. But short-term, and based on the experiences in the past, and this classic buy the dip approach, when there was stimulus delivered from central banks over the last 10 years, usually went up the market. So as long as the market finds itself in this bias and in this thinking, it looks not very promising to short the market here and to be skeptical. So this is definitely something you should be aware of when thinking about short-term short engagements here, even though, again, from a seasonal perspective, short S&P 500 in the next 5 days seems a good idea. Yeah, and in this regard, then it definitely makes also look at the price action in the DAX, and the fact that we didn't break higher so far, even though market environment was thin enough. There was also potential bullish driver with the Fed, respectively the remarks from Mario Draghi on Tuesday. If we didn't break higher here, this is also something to be skeptical about. Still, we can say, as long as we trade here above the simple moving average 200, respectively above 11,600 points, the picture is still positive. And if we break out, if this is only let's call it taking a breath here, and then jump above that level in the next week, probably because there will be some remarks made in regards to expectations around the meeting between Trump and Xi Jinping in Osaka here at the G20 summit. If a break happens, then further gains are very likely, and probably the DAX can push as high as 12,900 points. It could be also quite strong breakout, which we could expect here. Even though, again, we probably should wait for the break, respectively, try to anticipate it if we trade closely before this level, and not aggressively try to anticipate it from the current region here. So, and yeah, so all in all, that's it, in fact, from my end. Probably here, this is the final picture. We can close this webinar then with, it's something I mentioned at the beginning. When you're skeptical about the US dollar, probably the Euro USD is not necessarily the best choice because of the fear around a trade war escalation between Europe and the US. In this context, dollar JPY is probably a better candidate. So being short dollar JPY. This is also true if a trade, since a trade war escalation should usually be expected to give some kind of risk-off driver into the market. It's only negatively correlated to gold. The overall outlook for gold is bullish. Still, short-term corrective move seems a possibility. So potential short trigger 107.80, probably a little higher 108. As long as we trade below 109, I'm sorry, 109, 108.80, 109. Here, the last relative high, the mode definitely stays bearish, dollar JPY on a daily time frame, and the target, which is can be found here around the flash price lows, can be found around 105, 104.70, 105 JPY, and that's it. So I hope you enjoyed this webinar. I wish you happy trading. All the best. Have a nice weekend. Enjoy yourself. Talk to you again next week on Friday then, and that's it from my end. So all the best. Talk to you later. See you, and bye-bye.